Good afternoon. Good afternoon. Shall we start? Okay. Yes, I'm going to discuss in advanced diploma in credit management the lending products, especially for large businesses, large corporates. What type of lending products available for us? So we first will discuss the syndicated loans or syndicate loan or the consortium loans. Syndicate loan is normally known as a syndicated bank facility. It's a loan offered by a group of lenders. That means number of lenders, referred as syndicate, work to provide funds for a single borrower. I feel the problem comes in the large corporations, large business requirements are normally cannot be handled by a single bank. You can hear? I can't hear you. Hello? Yeah? Slides are not, you can't see the slides? Slides pane at the? Hello? Slides pane at the?
Can see, sir.
Huh? Can see?
Yes.
You can't hear me?
Can hear you, sir.
Yeah. Okay, then we can continue, no?
So someone's mic has on, that's why.
Ah, I see. Mic एक ऑफ कराना है. Okay. I think now it's okay. I also can hear some noises. Okay, syndicate loan normally we handle when it comes to specifically large loan facilities need by one customer, single borrower. But that facility cannot be entertained by a one bank or a lending institution because the volume is very large. Therefore, there are two reasons. One is risk element. Second part is some banks does not have authority or ability to lend because the single borrower limits are there established by the central bank. So therefore, they have to restrict certain amounts, some banks, small banks. So therefore, if a customer needed for a large facility, the next alternative is go for a syndicate loan. That means the syndicate loan is a bank facility. It's a loan offered by a group of lenders. Number of banks get together, referred as a syndicate, work together and provide fund for a single borrower. Number of lenders, one borrower. Right? The borrower could be a corporation, a large project, or a sovereign. Sovereign can be a government organization, sovereignty, such as a government. The loan can involve fixed amount of funds, a credit line, or combination of two. Sometimes you may find the loan is connected with some credit lines, ADB credit line or World Bank credit line, like that. It can be linked to a credit line or a combination of, or it can be own funds, a bank's own funds, right? So basically, syndicate loan is there are number of lenders with single borrower with single document. That's easy. The process of involving several different lenders in providing various portions of loan is difficult. The loan syndication most often occurs in situations where the borrower requires a large sum of capital that may either be too much for a single lender to provide or may be outside the scope of lenders' risk exposure levels. So banks normally, all the banks or finance institutions, we have certain what you call risk exposure levels for a particular segment or a particular company or a particular industry, the bank has their own exposure limits. Exposure limit, that means they are not going beyond that point, the risk can be exposed. So the risk, most of the banks, all the banks, they should maintain their risk exposure level for different categories of products, lending products. So if it's going beyond that, then we cannot refuse the customer about the facility. So alternative is going for getting another one of you lenders get together jointly and grant the facility. Thus, multiple lenders will work together to provide the borrower with the capital needed at an appropriate rate agreed upon by all the lenders. So this is a collective measure. When project is unusually large or complex, it may be exceeded the capacity of single lender. For example, the amount of loan may be too large, the risk is too high. The collateral may be in different locations, or the user's capital may require special expertise to understand and manage it. In these cases, a financial institution may bring other lenders into the deal. Right? There are a number of reasons why it goes. First one is, most important thing, the risk exposure levels. Right? They cannot go according to central bank regulations. The maximum amount can be lent is defined. 15% of the capital, more than that we can't go. So that's one of the limitations. Or a particular project is very high risk. So if you take a high risk by a single borrower, if something happened to that particular project, the bank may collapse. Therefore, the sharing the risk. Another second objective is to share the high risk project with other banks. Then third one is the collateral. It can be single collateral or different collateral. But with one documentation, the collateral will be charged to the lending institutions. Right. Then or else that project is needed specialized technical knowledge to handle that facility. So sometimes our bank may not be having that expertise. So we may join with some other banks which is having that expertise to go for that lending. Right? So these are the instances where project the syndicate loans are discussed and developed. Syndicate loans are arising when project requires a too large loan for a single lender, or when a project needs specialized lender with the expertise in specific asset class. We discussed it a little earlier. Either project is too large, one bank cannot be handled, or syndicating the loan of project allows lenders to spread the risk, and take part in financial opportunities that may be too large for their individual capital base. So depending on the capital base of the banks, right, the maximum amount can be lent is defined in the lending limits. You cannot go beyond that. Right? So that within that limit, if you exceed that limit, the banks has to go for a syndicate facility. The interest rates on this type of loan can be fixed or floating based on the benchmark, such as the London Interbank Offering. We don't go for by LIBOR. We are going by central bank. We are going by the WLPR, right? Weighted lending rate, right? 1% or 5% or 2% above that. That's a lending price fixed by. So the interest rates will be decided by the lending bank get together, and it can be either floating or fixed. Floating fixed means in the entire period, interest will be fixed. Interest rate will be fixed. right? Because there's a risk in going for fixed interest rate. If the market interest rate is changing, if it is going increasing, then the bank will lose. If it is decreasing, customer may lose. Therefore, normally in these large facilities, we go for a floating rate. Can be either 3 months, once in 3 months, once in 6 months, can be discussed and negotiated and fixed interest rate. Right? What are the features of syndicate loans? There are 2 or more banks because syndicate lenders. There should be 2 or more. Any number of banks get together, join. There's no limit for that. Contract with borrower to provide credit on the common terms and conditions governed by a common document. Single document. Now we'll take the case. If a borrower wants a large facility, if one bank cannot give that facility, that borrower has to go to other banks also to cover up that what is requirement. If you go for 2 banks, 2 different policies, 2 different lending characters. Sometimes interest rate may be different. Documentation, 2 different documents. Then you need to what do you call the collateral. With one collateral, you cannot go for this type of lending. If you go 2 banks, with one collateral, you can't go because you cannot divide the collateral between banks. Right? Therefore, there's a certain limitations the borrowers. To overcome these situations, only the bank has developed this product. Right? It's a common document, single document. That is one loan agreement, in other words. One loan agreement, one is a property mortgage, is one property mortgage bond. But it's charged to different banks. Right? The multi-bank transaction, each bank acting severally. Although the different banks are coming for common conditions, common documents, each and every bank has a right to act separately. Whenever needed, they can go against this consortium and take action. For example, if one bank wants to withdraw from the consortium, he can do it. That bank can do it. Right? Either he can transfer his position to some other bank or distribute among the other banks and get out from the syndication. That opportunity is available for any bank who is participating in this syndicate loans. Although common documentation, a bank have ultimately the individual right to take legal action against the borrower. This is very important. Right? Because although it's a common documentation, one common document, a common loan agreement, if a bank wanted to take a legal action for a violation of condition, that bank have put certain condition, it's a covenants, they can go for take legal action individually without considering or concentrating other participants, other lenders. So that is advantage in this syndicate loans, right? So there are basic, more important features are there are more than 2 banks involved in the lending with the common documents, common terms and conditions. Then, although it is common document, the banking transaction can act separate. Banks can act separately, right? Even a bank can take legal action against the borrower if the conditions are violated without waiting for other lenders or the other parties in the syndication. So that advantage is there. Interest usually accrues at a variable or floating rate and it's reset periodically at agreed interval, usually at borrower's choice. Normally, facilities, the interest rate can be either it can be variable or floating or fixed rate. When it comes to floating or variable rate, the rate will be agreed between the borrower and the banks of how often it should be reviewed. Right? If the loan interest rates are fluctuating very rapidly, once in 3 months, may be possible. Or else, make it fixed for once a year, like that, annually. It can be changed. The facility is normally a median term maturity at 3 to 10 years. So normally syndicate loans are going for long period. Specifically, syndicate loans are taken for capital investment. Therefore, it need normally a long-term facility. Right? Normally 3 to 10 years a long-term facility. Bank participate on a common terms and conditions, but necessarily equal amount. In the other important factor is the participating amount may not be equal. For example, if a 1 billion loan is needed, if 4 banks are involved, we say, right, 1 billion needed, 2.5 million, it can be divided according to their requirement. It's not necessarily be at 0.25 billion, each bank has to be contributed. No, not necessarily. One bank can give 0.5 billion, or one other bank can give 0.1 billion, 0.1 billion or 0.2 billion, depending on their capacity and the risk-bearing ability. It can be vary, not necessarily equal amount. Why you go for syndicate loans? The objectives are the main goal of syndicated loans, spreading the risks of the borrower default across the multiple lenders, such as banks or institutional investors, such as pension fund and hedge funds. Now, syndicate loans not necessarily be a bank. Okay. When participating banks, when it comes to participating lenders, may not be a bank. It can be a commercial bank. It can be a specialized bank or any outside institutional funds. Pension funds, like in Sri Lanka, we get this what do you call EPF, ETF funds, or some large companies. Large companies, they have the provident fund. Funds are not in with the government provident fund, their own provident funds are allowed. So such funds can be invested in this type of investment, syndicate loans, or hedge funds, hedging the funds, right? Because syndicate loans tend to be much larger than the standard bank loans. It is the larger than the normal size of a bank lending. The risk of even one borrower defaulting could cripple a single lender. It can happen. If depending on one borrower, certain banks, depending on sometimes one borrower, large amount of investment in with that borrower, right? For example, now it's not allowed by central bank. The maximum 15%, more than that you can't go now. Earlier, even 40%, 50% of the entire loan portfolio is with one borrower. Sometimes you may find some borrowers are a group of companies. A group of companies. So the group of company individually taking facilities. When the collective comes to, it is more than the lending ability of that particular bank. Then there will be a risk. There can be risk. So as lenders, we have to be very alert when you are lending to specifically corporate, large corporates. Consider the group as a total and get the percentage, how much of percentage can be lent. Okay. Syndicated loans are also used in the leveraged buyout community to fund large corporate takeovers with primary debt funding. What is this buyout? Now, certain companies want to buy another company. Certain company want to buy another. We'll take an example. Sometime back, the pure beverages. Pure beverages bought by Cargills. We call leverage buyout. Buy out, buying the entire business. So when we such instances, to buy or to purchase that particular company, the buyer may need a large amount of funds. So the corporate takeover is primary debt funding. So they can ask from the bank for a syndicate facility to invest in that buyout. Right? So in the business world, if you look at the business world, how it operate, there are companies which have been transferring from one company to another. It's revolving. Right? So the large business people may tend to buy small businesses and make their group a large group, and to become a controlling the economy by that group. So such instances, the bank has to be very alert, very careful. The objective of the borrower, what is the objective, and whether that can be an adverse impact on the bank's image. Right? This can be, in the recent past, we have seen, I am not going to divulge the names. If you have gone to the newspapers, especially business column, you may have seen these transactions and deviations. So the bank has to be alert when you go for loan. Such company wanted certain funds, bank has to be alert on that transaction. Right? Whether it can go sometime against that. Sometime back, I can remember there was a case sometime back regarding buying shares of a company, a bank, buying shares of a company, the bank, and a certain conglomerate, business conglomerate, wanted to buy shares of a particular commercial bank. Right? If they buy that shares, the controlling interest of that bank will go to that particular company. Okay. So it's a risk in the industry, the banking industry. So therefore, the transaction has to be stopped by Banking Act number 30 of 1988 provides certain conditions. Anybody can purchase any amount of shares of the banks, but voting rights are limited to 5%. Right? Voting rights are not given. That means the controlling interest cannot be taken. So there are legal sides when you are going for this type of transactions. Anyway, we as bankers, now I am considering you as advanced diploma. This is not a low-level class. It is a very high advanced level of knowledge you should have about the market conditions, market behavior. You have to observe these things when you are going for lending. Okay, so the syndicate loan, one of the products, right? Like typically in cases of syndicate loan, there's a lead bank or underwriter of the loan known as the arranger, the agent or the lead lender. The lender may put up proportionately bigger share of the loan or it may perform duties such as dispersing cash flows among the other syndicate members and administrative risk. Now, who are the parties involved in syndicate loan? We'll go in details for that a little later. Right? One, the main bank is called lead bank, who organized this syndicate loan. The bank called lead bank is the bank which is originally arranging the loan. That means customer negotiate, the borrower negotiate with the lead bank. Customer not going to all the banks, other banks to find out facilities available. No. The particular lead bank come forward and arrange for a facility for the particular customer. So now, when the lead bank arranges for facility, lead bank will call other banks to participate. You know, it's not the arranger, the agent, or the lead, then the number of terminology used for this lead bank. I'll come to the underwriting a little later. What is underwriting is different rule. Arrange, agent, or a lead lender. Right? So he put the proposal to the other bank. Lead bank will put the proposal to other bank that such an amount of funds needed by a particular company, and anybody want to participate in that lending syndicate. The lender may put up proportionally bigger share on the loan sometime. So then he is the person, or the lead bank will be organizing this credit facility and collecting funds, making the cash flow with the borrower, right? So all the administrative work done by the lead bank, right? Now, when companies are going for borrowing, normally investment grade should be S&P, Standard Poor, Moody's. These are rating agencies, rating companies, which are given the rating for different companies. AAA is the highest risk-free type of company, according to Standard & Poor, AAA, Moody's also. Then A, AA plus, AA minus, A. Up to this point, up to B, BBB, the investment grade is very high. That means that companies are sound in financial. So any bank going for lend for a company, first they see whether that company have a strong financial background. So they basically depend on these ratings. The S&P, Moody's. In Sri Lanka, you get rich, right? Ratings in Sri Lanka, rich. You would have seen the recent case is about the sovereign lending. What is the position of Sri Lanka? It has come down from B to C. Down, that means distress level. It has come to distress level. Sri Lanka's borrowing, sovereign borrowings. So it may have an impact on the banks also, like long, the medium term. Anyway, so the company has to be a rated company. Specifically, banks are going for A and above. Maximum would be BBB plus, not below that, right? Although it is risk rating, very high risk rating. Right. What type of funds can be given under this syndicate loans? Short-term finance, where the funds are required up to period of 1 year. Such finance is required to meet the working capital requirement or a special seasonal needs. Depending on the need, the product size is different. Period is different. Sometimes large corporations, a large amount of money for working capital. Within 1 year, they can rebuild their working capital. That's a short-term finance. Then medium term of finance comes to needed for 1 to 5 years. Such finance is needed to provide funds for permanent working capital, expansion or replacement of assets, etc. These are available from SFS or commercial banks, finance companies or commercial banks, and this in Indian situation through special schemes for India, but Sri Lanka we don't have this type of arrangement. But we have commercial banks and finance companies, and in the money market operations, operation people are there, institutions are there, right? So medium term. So short working capital, permanent working capital. This is revolving working capital. This is permanent working capital. What purpose of permanent working capital needed? What is the permanent working capital? Permanent working capital is the working capital is blocked. It is not moving. It is revolving, but the amount is revolving within the same limit. Within a certain amount, it will revolve, but it will be fixed. What are the type of product in the balance sheet of a customer? So this is when you are calculating working capital finance, is an important factor. It is debtors and inventory. Debtors and inventory are the permanent working capital, which is not moving, it is fixed. Revolving working capital is day-to-day operations, as the cost of goods sold and other expenses. Right. Then comes long-term facilities, which is needed for more than 5 years. That is structural facilities, construction and other long-term facilities. Right. So type of funds you needed can be divided. Let's see the structure of leasing this syndicate loans. Now the borrower needs certain money, 1 billion rupees for a project, for example. Right? Now he organized with the lead bank or the lead manager, you call lead bank or lead manager agent, discuss directly with the lead manager. The lead manager or lead bank, as mentioned earlier, invite other banks to participate. So bank A, bank B, bank C will agree to lend this money. For example, if you say 1 billion, 1,000 million, 500 million will be given by A. 250 million, 250 million will be given by the B and C. So lead bank may not take any share of this lending. Lead bank may take a share or may not take a share. That depends. It is not compulsory the lead bank also should participate. No, it is not necessary. Right? The lead bank will call participating bank to contribute. Once they are contributed, then the documents will be arranged. Contract will be signed. Loan agreement will be signed with the borrower and the lead bank. All the terms and conditions. So monitoring administration of this facility is done by the lead bank. These participating banks will not involve in that part. For example, loan recovery. Loan recovery is not the role of these banks. Participating bank. It is a lead bank. Recover the facilities, installments, and distribute among these banks according to their terms and conditions. Okay. Now, who is underwriter? Who is underwriter? Now, underwriters are when the lead, whenever investment is put across, if there's no fully participation for that particular investment, some organization, bank or a lending institution will take responsibility to buy the shortfall. By the shortfall. That bank is called underwriting bank or underwriter. we'll take the example that 1 billion, 1,000 million. Now, out of 1,000 million, Bank A took 250 million, Bank B took 250 million, Bank C took only 10 million. So, 100 million. Sorry, I have 250 million, 250 million, 100 million. So only 600 million has been participated, whereas the 400 million is left behind. Now that part, either lead bank will take over as underwriter, so then the lead bank also plays the role of underwriter, or prior to this arrangement, lead bank can arrange for an underwriter, another bank, who will take over the balance, this 400 million, and fulfill the loan transaction. Okay, this is a structure, how it is operated. Let's go into details. What is the lead manager's role? The lead bank. The bank that is awarded the mandate by the prospective borrower. That is, the negotiation is done by for the loan with the lead bank. Lead bank will negotiate with the borrower, the customer. It is responsible for placing syndicate loan with other banks. After that, arrangements are made. Lead bank will call other banks to participate. Other banks to participate. It ensures that the syndicate loan is fully subscribed. So it's a role of lead manager to see whether the full amount needed should be subscribed by the participating banks. So what is the lead manager getting for this arrangement is getting a fee. It's called eligible for an arrangement fee. Right? So lead manager, like I told earlier, need not to be a participant. May be a participant, may not be a participant. Okay. Then underwriting bank is the bank commits to supply funds to the borrower in case of a deficit, undersubscribed. This is undersubscribed amount. So another outside bank will take over the responsibility of as underwriting bank. If necessary, from its own resources, if loan is not fully subscribed. Sometimes, if the loan is not fully subscribed, the lead bank may take over that part as underwriting bank. So lead bank can play a role of a lead bank arrangement also as underwriting bank to fulfill the undersubscribed amount. What are things to be looked into? Where undersubscribed situation comes because the risk factor. Sometimes the risk of the bank may consider about the risk. The loan may not fully subscribe, not all the loans are underwritten. Sometimes you may find it is oversubscribed, right? So not necessary for going for underwriting. If you're going for underwriting, the underwriting bank also charge for underwriting fee. And once the company is established, the underwriting bank can sell off his loan portfolio to other banks. Okay. Now this similar situation is happening in the share market also. Share market also is normally a company putting the market IPO, initial public offer. Right? When you put it to the market, if it's not sold, shares are not sold, a certain finance companies or organization will act as underwriters. Most of the instances you would have seen, the merchant banks in Sri Lanka plays this role as underwriting bank. They buy the undersubscribed portion of the issues. Right? It can be a bank or a financial institution which have funds. If necessary from its own resources, not a risk factor and not this is not fully subscribed. Then the other one, third bank, third party, participating bank. The bank that participates is indicated by lending a portion of a total loan amount required. get interest income and participating fees. So participating bank get two types of income. For their lending, they get interest. For participation fee can be charged. There are two types of income participating banks are getting involved in this transaction. So the lead bank, what's the role of lead bank, how the lead bank operates, what are the benefits of the lead bank, what are the benefits of the underwriting bank, what are the benefits of the participating bank. Okay, we'll discuss that. So what are the risks for the participating bank? Normal credit risk. It's a normal lending. So normal credit risk has to be looked into. So any participating bank, although the leading agent or leading bank will go through the risk factor, normal risk factor, everything will be evaluate before it put into participating bank. Participating banks also have a duty to go for individually look into the risk factor. What type of risk in this transaction? It's a normal, like a credit, normal lending. Participating bank may lead into a passive approval and complacency when many high-profile banks cannot be go wrong. This is a myth with the participating banks. The participating bank is a small bank. Sorry. The participating bank is a small bank. Then sometimes they may not go for in-depth analysis about the risk. They have a myth that passive approval, the other large bank was involved in the investment participation. With the they may not go wrong. Large banks. So sometimes small banks may follow the footstep of the large bank. It's a misconception. Then second problem is participating bank funding risk. Mismatch of fund inflows and outflows. If a participating bank invests in a syndicate loan, their cash flow will get outflows are high. To match this outflow, what is the inflow to the participating bank? So participating bank before investing or participating has to evaluate these two, risk factor and the funding risk specifically. If the funding risk arises, for example, a small bank, 250 million has invested in the participated in the syndicate. Sorry. The syndicate. Because of that syndication, the particular participating bank may go out of cash for their day-to-day operation. They may face a liquidity risk. That's called funding risk. 250 million, for example, given to this fund. That particular bank should have sufficient surplus funds to do that. Otherwise, what will happen? That particular bank, participating bank, may face for a liquidity crisis situation. Therefore, the funding risk is very high. You have to match the funds inflows and outflows carefully. Also, advantages to the borrower. Dealing with single bank, they don't go to the borrower didn't need to go to different bank for this part of lending. With a single bank, that is the lead bank. Single contact point, single documents, only one document, that is the loan agreement, syndicate loan agreement. Then documentation also same. Then borrower have advantage access to a large amount of funds, bank funds, right? And also sophisticated investor base. With this particular borrower, number of participating banks are coming to the transaction indirectly. So large investor base with this particular borrower is an advantage to the borrower to show their prestige, their high prestige of this borrower. It's a plus point for their ratings. If a borrower has a number of participating banks are involved, the borrower's rating may go up because of the investor basis, large investor base is there to be invested in the particular company. Okay, right. Relatively low price and finer terms, highly flexible. Pricing can be negotiated, interest rate can be negotiated. So normally, if you're going for a syndicate loan, relatively low price. And also terms and conditions are very flexible. Then borrower have the access to wider range of banks, greater speed and reasonable certainty of obtaining fund. When syndicate facilities are developed, the borrower has certainty that the money needed, the funds needed by him can be established, built up. Simpler than other ways of raising fund, issuing bonds or equity. Otherwise, what will happen for the large amount we are needed, company has to issue shares or debentures, right? So those are money market instruments. Without going to bank, we call this intermediation of bank, go to the money market and collect funds. That's also possible, right? So then it becomes a little cumbersome when the bonds and equity or what you call debentures are issued, little cumbersome of transactions and operating expenses, operating methodology will be complex. Okay. What are the advantages to the lead bank arrangement? Without committing a capital, lead bank get a fee. Lead bank arrange for the funds and get a fee or commission for that arrangement. So no investment or nothing has been invested. There's no risk at all for the lead bank. Okay. Then if a bank arrange for a syndicate facility, it will enhance the reputation of the company. The bank's reputation will be increased. Enhance the bank relationship with the client, right? That means for the borrowers, commitment and confidence on the bank has been increased, and therefore it is very good relationship can be developed. What are the advantages to participate in bank? Diversification of risk, exposure not prescribed by central bank. Risk without going for small number of facilities with a high risk. The bank can, in the participation, can give a facility for one particular customer, and the operating risk can be reduced. Access to lending opportunities with low marketing cost. Participating bank also get opportunities getting from the market low price funds from the money market as well as the capital market. Opportunities to participate future syndications. This is an experience. Exposure also get a small bank. So future participation in the syndicates can get involved in the syndications. Right? In case of borrower runs difficulties, participant bank have equal treatment, no disadvantages of the size, vice versa, dominant bigger bank. Right? In case of a borrower runs difficulty, defaulting scenario, participant bank can take immediately action to sell off the position or file action against the borrower, right? Without waiting for the other banks to come in to see. It is not necessary collectively file action, no? Individually banks can do that. Right? Then recognition for the participating bank. It's a prestige situation. Interest and fee, we just discussed earlier. Anytime participating banks can anytime transfer this facility to any bank or sell it to any bank subsequently. So this product is very commonly used, commonly practiced for with the large corporate borrowings. You may can see this type of products are operating in the market. Now, what is the deal? The underwriting deal or underwriting deal is the agreement between the leading bank or with the borrower. If any amount undersubscribed will be by the underwriting bank. So, because in other words, the underwriter will be giving a guarantee to the syndicate that entire loan will be subscribed. Entire loan will be made available to the borrower. So therefore, any shortfall, underwriting bank will take over. That's called underwriting deal. The underwriting deal is one of the most widely available types of syndicate loans in the Europe. Under this arrangement, the lead agent or underwriter guarantees the syndicate's entire loan. If the loan has not fully subscribed, the lead agent can up to absorb the undersubscribed portion. That's called underwriting or underwriting deal. Then the market conditions are bullish. Market conditions are good. The same lead agent can sell to other investors undersubscribed part of the loan that it has absorbed. Bullish means when the market condition, if the company is doing well, company's position is very increasing, right? So that underwritten portion can be sold to some other finance company, financial institution. However, it makes bearish. The lead arranger may be forced to sell any undersubscribed portion at a discount or simply consider holding as a loss. If the company default the facility, company borrower defaults facility, so underwriter will go bear the losses. The underwriter has to bear the losses for his underwritten portion of the loan. If it's going increasing, they can sell for higher amount. If decreasing, and bear the loss. There are several reasons why the bank may decide to become underwriter. First, this type of loan can make financial institution look more competitive. Why these banks are taking part in syndicate facilities as underwriter? This is in a competitive and financial market, right? The financial institution can be more competitive edge by opting to be underwriter. Next, the syndicated debt could mean huge profit for the bank because the risk involved in this type of loan can translate into higher service fees. Right? Now, when you transfer in these facilities, I would see if in the share market, if you call underwriter, buy the shares, the share prices increase. When you sell the shares, right, he gets a profit from the shares. But in the syndicate loans, there's no book. We have to sell for the book value only. You cannot sell high price, but the cost, the risk for the risk they are taken, can charge a higher service fee, higher commission, by which the underwriter will earn a lot of money. Okay. Lastly, underwritten deals now have floating interest rates. Thus, the risks are no longer high as the debts with the fixed rates. So rates are changing. Therefore, when the rates are changed, the risk also accordingly adjusted. Right. Now, what are the types of deals we are talking about? Syndicate loans. First one is we are discussing underwritten deal. The second type of syndicate loans called club deal. This type of syndicate usually entails small amount, typically between, this is the US scenario, 25 to 150 million US dollars. The main feature that makes this type of a syndicate loan unique is the fact that the lead agent and other members of a club deal consortium shall share the equal or nearly equal parts of the fees earned from the loan facility. Right? Now, this is when it comes to club deal, all the syndicating participants, lead agent and other participant, they share the fees earned from the facility equal or nearly equal. Right? So small type of investments and sharing the returns, that is the fees earned from the customer, will be shared equal or close to equal shares. The third type of syndicate loans called best effort syndicate loans. All the types of syndicate loans, the best effort syndicate is the most commonly used in the United States. Under this agreement, the lead agent does not commit or guarantee the entire amount of loan. In other words, when best effort syndication of facility, right? Lead bank will not take or commit for any amount of for the facility. Right? The undersubscribed portion of loan will be filled by a taking advantage of change in the market conditions. Right? They are not guaranteeing for the entire amount for the loan, but have the option to buy the shortfall with the market conditions. However, if the loan continues to be undersubscribed, the borrower may be forced to accept lower loan amount or loan agreement cancelled entirely. Normally, the best effort syndicate loan, if there's no syndication or syndication is not the syndicated participation will not come forward, then borrower have to accept the amount lower than the amount you have. For example, we discussed earlier, 1 billion facility, 1,000 million facility. Now it's only subscribed 600 million. If the lead bank willing to take the balance 400 million, no problem. Or any underwriter have been arranged for that 400 million, no problem. But if it's market conditions are not favorable, right, then borrower may then the lead bank may say, okay, this is the amount only can be collected, whether you are willing to take it or not. So that's option available for the borrower to accept it as it is, the lower amount, or entire loan agreement to be cancelled entirely. So the deal can be completely cancelled. So that's called best effort syndicate deal. So there are 3 types of syndicate deals. First one is we discussed underwritten deal. There are underwriter will take over the undersubscribed portion. The club deal, we have the small type of facilities. The service charges earned by the banks will be equally shared. Then the best effort syndication loan, where under the arranging party, that is the lead bank, may not take participate in the participation in the loan facility, or no make any commitment amount of the loan, or no commitment for the guarantee. So there can be therefore either, if any portion undersubscribed, it has to be with the customer willing to accept as it is the lower amount, or entire loan agreement can be cancelled. So that's called best effort syndicate loan. What are the instruments available for lending? Term loans, revolving facilities, and standby facilities. So, whereas these facilities are available for even for a medium size business, term loans, revolving facilities, and standby facilities. When it comes to corporate type of lending, the quantum is large. That's a different. So term loans can be short term, medium term, or long term. We discussed earlier. The revolving facilities. Normally short term facilities are revolving facilities. Revolving facilities are granted to meet ongoing day-to-day operation expenses, operational transactions. Standby facilities are established, keep standby. Whenever needed, they put into the field. Right. Finally, let us see what are the stages involved in lending at the this type of syndicate loans. The prospective borrower may liaise with a single bank, or it may invite competitive bids for the number of banks. First stage, usually, they have to, the borrower has to prepare their loan requirement, prepare a needs loan requirement, and prepare the proposal and go to a bank and give the proposal. The lead bank need to, what to do? To identify the needs of the borrower. I told earlier, lead bank is the person who appraises facility. This credit proposal will be appraised by the lead bank, right? Initially, before it put into the participating bank. Identify the needs of the borrower. Will the borrower need that particular fund for that particular purpose, for that particular period? Need is not only amount. Need is amount, need is the period, need is the type of facilities. All this is have in the when you discuss about the need-based finance, all these things are there. So identify the need of the borrower. Deciding an appropriate credit structure, right? So when the need is analyzed, credit structure is very important. What is credit structure? According to the need, the credit has to be structured. Credit has to be structured with the need. Right? Let's see whether I can go to the board. Right. Now, for example, any business customer, credit need is, we can understand by 3 stages, 3 types of credit need. Any business, SME or a large corporate business, there are 3 types of facilities that are needed. First one, for a capital need. Capital need. That means construction, infrastructure development, warehouses, likewise commercial complexes, buildings. All this is a permanent fixed expenses. So to finance that type of need, customer need a long-term finance. For infrastructure development, it's a long-term finance. Long-term finance means is 5 to 10 years or more, depending on the project. Normally 5 to 10 years. So long-term need. Right? So need is for construction. Amount has to be developed. How do you find how much needed? Yeah, it is the BOQ. So you have the policy how much you are giving the BOQ. That has to be decided. BOQ or quantity survey report. That's the amount. How long it is needed? You will develop the cash flow. How the customer's cash flow is developed. Right? From the cash flow, you have to pay. It's a long-term facility. So you have to prepare a long-term cash flow for that. Any long-term facility has to be backed by a long-term tangible security. Long-term tangible security. That's the first need. Capital need, so long-term finance, 5 to 10 years, backed by a collateral, right? Long-term collateral. The second need is we discussed it a while ago. That is again capital need. Again capital need. Now this capital need has to be fulfilled with the medium-term finance. Construction long-term, medium-term finance. Period may be 3 to 5 years maximum. Medium-term facilities 3 to 5 years. That also a capital need. What type of capital need? Purchasing of vehicles, purchasing of machinery, right? Vehicles, machinery, furniture and fittings. Now these are needed 3 to 5 years facility. It's called medium-term facility. Then third part is revolving facility. In other words, we call as working capital facility. It's a short-term facility, less than 1 year. 1 year or less. It's a short-term facility. For what purpose you are needed for that? That need arises from what? Yeah? Working capital. First part is permanent working capital. So, permanent working capital is there 1 year. Right? For purposes, I did this little while ago, I told you, inventory and debtors. Financing in inventory and debtors. Needed a short-term finance. Right? Within 1 year, it has been revolved. Then, fourth part is revolving working capital need. Permanent working capital, revolving working capital. Revolving working capital need arises to day-to-day operations. Day-to-day need. What are the day-to-day need? Cost of goods sold. CGS is the purchases. Cost of goods sold. Secondly, expenses. Cost of goods sold, expenses. If it's in a manufacturing organization, we call this part called as WIP, work in progress. right? There are four types we that divided into four types of needs of the customer: capital need, long-term capital, medium-term capital, the working capital need, permanent working capital, revolving working capital. Normally, revolving working capital we give with a permanent overdraft facility. It can be revolved. It's a revolving facility, right? So identify needs of the borrower and design appropriate credit structure. This is the weakest point in our industry. Whenever customer does not have an idea, even corporate customers, you may find that they don't have a proper idea about how to structure their need. So the bank has to do that. Otherwise, we'll be in problem. In practice, normally even if you take a small loan, if a customer comes and asks for a facility, you give that facility. You are not looking into the customer need. What's the need? But for what purpose is investing this one? Whether it is appropriate. Okay. So you decide according to the structure, according to the customer's need. Then develop a persuasive proposal. That proposal should be attractive to the participating banks. This is the role of the lead bank, right? Lead bank has to see, develop a persuasive proposal. It has to be acceptable. That means to persuade, to make interest on the proposal. Develop a proposal interesting manner. Then on approval, award the mandate. When the participating banks have been agreed to participate, then award the mandate means sign the agreement with the customer. Right? So these are steps involved in syndicate loans. Right. That's all about talk about syndicate loans. I think last time I had asked the questions. So the syndicate loans, very important factor, few things we have to look into are some of the very important factors are. So basically syndicate loans are granted for facilities, large facilities, where one bank cannot be taken off. So what are the capacities of each bank has to be developed, looked into. According to central bank guidelines, each bank has certain limitations for the capital, how much they can give. For a single borrower, for one borrower, how much can be given. Depending on the limitation, participants cannot be, the banks cannot go to entertain the customer's requirement. Then you have to go for a syndication. Syndication means simple, one borrower, number of lenders. With a common document, common terms and conditions, and recovery will be made by the lead bank and distributed to the participating banks. Although it's a common document, individual participating banks have the right to take action, legal action against the borrower whenever they are needed. Any participating bank want to release from the participation, they can do that, sell their part to somebody, some other company, some other financier, and go ahead. So these are the important part in syndication of loan syndication. Okay, shall we have small break and come back?
Yes, sir. We can hear you.
Can you see the screen?
Yes, yes. Okay.
Okay, so let's start. The other product we are going to discuss is venture capital financing. Venture capital. What is venture capital? What is venture capital finance? What is this product? How best we can apply? What is the position in Sri Lanka regarding this venture capital financing concept? Venture capital, in the word itself, gives a venture is a project, undertaking or involving risk. They have to do or say something or risk, very high risk project called venture. Capital is how much you are going to invest in it. A project, a venture is a project. In that project, how much going to invest? What is the cost of that project? What is the investment? Amount invested by the person to carry out the newly established business. So normally this venture capital financing, it's not a new thing. It is introduced some time back, but not much popular in our markets. What is venture capital? Right? It is, in other words, a project financing system. Right? Capital means fund employed in any business or activity. Capital means the amount invested in a business. It's called capital. Most important factor in the production, we will discuss in economics, in the production process, the capital is very important, the finance part of it. No economic entity can function without capital. So any economic activity needs capital. That is, finance is needed. So capital is also considered that the finance part needed for a project. Right? Funds employed in any business activity called a capital investment. Venture capital is a little different. Venture capital is significant innovation of 20th century. That is, last century it has been developed, that latter part of it. It is generally considered a synonym of risky capital. Venture capital is high risk. The capital investment part is high risk. Right? Venture capital is new financial service, the emergence of which wants to towards developing strategies to help new class of new businesses. New businesses has to be developed. It's called venture capital. In other words, venture capital is investing in capital for a venture or a project. Investment in a project. So the word itself giving a meaning for us. It is not a loan. Now we are talking about capital. Capital can be always, when you talk about capital, it is in the the proprietor or the owner's investment is called capital. That's why we have been learned all these days. There are certain part of capital bank will give as a loan. That's called loan capital. Now, when you come to venture capital, it does not mean the bank loan involving the venture capital. In other words, venture capital is not a loan. It's an investment in the capital. Right? Instead of a loan capital, somebody will be invest in that business as capital, called venture capital. Venture capital is equity support to fund new concepts that involve higher risk and at the same time have a high growth and profit. If any business started, new business started, for starting a business need capital. To start any business, you know that you need capital. So at the initial stages, the investors will not take part in investing in that business because there's a high risk whether that will be success or not. Whether we can see any success in that business or not. Therefore, mostly the bankers and investors or lenders look for the businesses which have been already established, not a startup company. Therefore, new ventures, new businesses coming up needed equity or the equity capital, and that to develop that fund into an innovative product. So therefore, it's a high risk involved in that. So anybody comes forward to take that risk and invest in that business is called venture capital. Same time, have a high growth and profit, because businesses are growing up very far rapidly, and once it grows, it generates profits. So the profit will be shared by the equity owners. So venture capital also get their part as a profit share for the investment, the capital invested in that business. Venture capital is broadly implies an investment of long-term equity finance in high-risk projects with a high reward possibility. In simple terms, venture capital broadly implies it's an investment. It's not a loan. When you carefully understand this, it is an investment in long-term equity finance in high-risk projects with high rewards possibilities. Return will be very high. Take high risk, high profit. That's a concept. So now there are three stages in venture capital financing. Venture capital financing, there are three stages. One is seed money. Second one is startup. Third one is first round. The second round, third round, fourth round, and exit. Okay, sorry for the inconvenience. There are 6 stages involved in this venture capital financing. First is seed money. Name itself is seed money is the first investment you're going to do, right? When a customer comes with a new idea, a person comes with a new idea to create something, to start done, initial capital is needed. That initial capital is called seed money. The initial capital to be invested is called seed money. So anybody going to invest in the initial capital in the venture capital field is called a seed money. Low-level financing needed to prove a new idea. We'll take an example. Some innovative product has been established. A person create a product. Now he wants to manufacture that item in commercial way, but he does not have money. So venture capital, if you go to bank, so it will take a long process to prove that what you call viability of that project. So when a viability of project is locked, by an investor can invest in that business to start the business. That's called seed money. Second one, startup. Early stage need funding for expenses associated with the marketing and product development. So startup means, if you put a graph, seed money is the new invest money. Second is picking up, startup. Startup stage, manufacturing is started, so needed operation expenses, raw materials, and to sell the products, marketing expenses, and product development. So those are the initial stages expenses, right? This third stage will be first round of where the manufacturer starts sales. In the new project started, manufacturer started, then the sales are started. So sales and the manufacturing cost is the funds needed in the first round. Second round, working capital for early stage companies that are selling product but not yet turning profit. Now, there are organizations, what do you call, ventures needed already started. They have already started, but they does not have sufficient working capital to continue the business. So that will become a second round investment. Where working capital for early stage companies that are selling product but not yet turning a profit. Still profit has not been earned by them. Still on the cost, recovering the cost. Or in other words, in the break-even level. That costs second round investment. When it comes to third round investment, it's called rationalized financing, this expansion money for newly profitable company. When your business is expanding, starting profits, generating profit, at that particular era, particular time, if you are going to invest in that business, it's called third round investment, or called rationalized financing. Now already business has been taken off, thus manufacturing started, sales are started, profits are started generating, right? Profit is now profitability mean that means can be profits are earned covering the cost, right? Then that means third round means that business is generating profits. In the third round comes generating profit. Fourth round is called a bridging finance. It means to finance the going public process. When venture capital is grown, the business is grown and gone, profits are generating, then the venture capitalist who have invested that money have the option to sell that his shares in public offering. Sell the shares in a public offering and recover his money with a profit. That means the shares can be sold at a higher level. It's called bearish situation where share prices will increase because the company is earning profit. Then by selling that, the investor can get back his money. It's called going public process. That's a step or called exit. Okay. So there are 6 stages you may find what venture capital can be invested. Seed money, that is initial stage, investing money to start a business. Then business is started, but they need the business for start the production. Fourth round, third steps in the first round. First round, sales are started, manufacturing started, cost is needed, investing that stage. Second round, that's the fourth step. Sorry, working capital needed for the business to ongoing process. To expand the business, working capital has to be expanded. For that, investment comes under second round. The third round comes when already now business is profitable, business is ongoing basis, and further whatever needed you are given, that's called merchandise financing or third round financing. Fourth round financing, to sell off their shares in a public option, make a public offering to sell off the shares and recover the money which are invested. Okay, so venture capital generally there are who are the parties involved in the roles. Venture capital company, venture capital general partners are also known as this case venture capitalists or VCs are executives in the company who are starting the company are called venture capital general partners. Or normally we call these people business called whoever starting the business, Arambha Karana, right? Who have executives in the business, who have started the business. The limited partners are second. Investors in the venture capital funds are known as limited partners. Whoever started the business are general partners. The limited partners are who are going to invest in that business. They are limited partners. The venture partners are being in deals and receive income only on the deals they work on. They bring the deals, that mean businesses, and receive income on the deals they work on. They are called venture partners. Fourth role in the venture capital firm is the EIR, or entrepreneur in residence, are experts in a particular domain and perform due diligence and potential deals. EIRs are engaged by VC firms. Some EIRs are moved to roles such as Chief Technology Officer at a portfolio company. That means to work out in a venture capital company, a particular expert in that business, right, who work in role as Chief Technical Officer, sometimes in the Indian companies you may find the CTO. He is the person who make going to sell the selling part of the business, to work out the due diligence reports and potential activities, potential positions, potential markets of the company. That's called entrepreneur in residence. So there are 4 types of partners involved in this venture capital company. So what are the features of venture capital company? The main features of venture capital are long-term horizon. That is, in general, venture capital take long-term to 5 to 10 years at a minimum to come out commercially successful. One should thus be able to wait patiently for the outcome of the switch. Now, this is a very, very important part to understand what is the venture capital business. Venture capital is a business. We started a seed investing in the business, and business will be take off, and it will take, to get the maturity to earn income, it takes 5 to 10 years. Until such time, more often, the venture capital is not getting any return. Venture capital is not getting any return. That is at a minimum to come out commercially successful. Once you're commercially successful only when the returns are started generating. One should thus be able to wait patiently for the outcome of venture. Therefore, venture capitalist has to wait till the company generate profits. It's a long time, a long time wait. That's why it differs from the normal loan. If you're given a loan, for example, you're given a loan, from the very first end of this month, starts the recovery program by installments. So any businesses has to pay whether they are earned profits or not, they have to service the loan. That's a disadvantage in loan against venture capital. Against venture capital, disadvantage in loan is loan has to be repaid immediately, or maybe given certain grace period, for example 6 months or 1 year till the business to establish. But until that period, the company business has to pay the interest to the loan. Therefore, newly startup businesses may not be able to service these loans. To survive the new companies, the alternative solution is the venture capital. A venture capitalist will invest money in the business and wait for a longer time patiently till it can generate income to get the benefit. on the business. Since a project is expected to run at startup stage for several years, liquidity may be a greater problem for that company. That's why I told you they cannot service a loan. Why? Liquidity may be a problem. Why the liquidity is a problem? The expenses incurred has to be earned by profits. Till it break even, the liquidity crisis situation may be there. So any business, when we are going to invest in the venture capital, we have to work out the break-even point, how long it will take to break even. After that, only start generating profit. So the projects, ventures, some more often will not generate profit immediately. It will take long term, several years, 3 to 4 years sometimes. So during that period, that company is facing liquidity crisis. That means the income generated may hardly sufficient to maintain their daily expenses. They can't do any other activities. Okay. Now take the situation, such a situation, if you are granted a facility loan, if the loan has to pay monthly installment, when the profits are not sufficient to cover up the cost, sales are not sufficient to cover up the cost, the loan may not be able to service. Therefore, it's high risk. So venture capital risk is that it will take a longer time, so we call longer mean about 5 to 6 years to generate profits. Until such time, the venture capitalist or investor has to wait and in a risky way, wait and see. Therefore, it's a high risk. The risk of project is associated with the management, product, and operations. So the risk can be associated with whether the success or not, depending on the management. How best the management can absorb the pressure on the liquidity problem. Product, whether product is marketable, accepted to the market. Sometimes a product put in the market takes some time to pursue the customers to buy that product. The operation, by seeing the time, may be costly. Operational cost may be has to be serviced. So these are the features in venture capital, venture capital. Right? Right? It's a long-term liquidity, short-term liquidity crisis may arise, and there's a high risk. Then the next one is high tech. However, venture capitalists look not only for the high technology, but the innovativeness through which the project can be succeed. Therefore, always in a venture capital, they look for new ventures, new innovations to get this quick. The project can be success quickly. New techniques and new innovations. Right? So, next important factor is equity participation and capital gains. Venture capitalists invest his money in terms of equity, right? Clearly understood? A venture capitalist, whoever invests in a business, his money in terms of equities, put in equity to the company, capital to the company. He does not look for any dividend or other benefit. This is very, very important. Immediately, no return is expected. No profit has been expected. Any dividend or any other benefit from the business. But when the project commercially success, when the project commercially success, that means after some time, profits are generated, commercially viable and success, then he enjoy the capital gain, which is the main benefit. What is the capital gain? By selling his capital portion for higher value, share prices will go up, then he can earn capital gain. By selling his shares, he can gain capital gain. So that is the profit. Right? So that's the main benefit. And also Unlike also venture capitalists can participate in the management because they are the equity partners. व्यापारे हाउल करो व्यापारे को ट्रस्ट करो equity share. Therefore, they can participate in the management. Right? Unlike traditional financier or banker, the venture capitalists can provide managerial expertise to entrepreneurs besides the money. Not only invest in the money, but give the expertise of that particular person can be given to the management can be give his contribution to the management also, because he's also his investment part of the capital. So whatever gains company gets, he also gets the gain. But if you compare with a financier or a banker, if you invest in given a loan to company, business or project, you get only the interest. You cannot put your finger into the business. That means you cannot tell what to do or to manage the business. Only the return is the interest. No other benefit. This is pre-decided. But venture capital, it is not pre-decided. How much you are getting, no one knows. After commercially viable only, commercial success only, the benefits are getting reached. Therefore, the venture capital features, very important features we have to understand. It takes long time to earn profit. During that time, liquidity prices can happen. There are high risks. Specifically, high-tech industries need this venture capital. The venture capitalist getting the capital gains, and he's involved in the management. Right. Before I go to the advantages of the venture capital, some important factors to understand what is venture capital. Very in the simple terms. Very simple terms. Venture capital is a venture capitalist investing his money in the business as equity, not as a loan. The loan has to be paid off, but equity need not to be paid back. Right? And no immediate return like loans. No interest return is getting. You have to wait till the company establish and generate profit. Until such time, wait patiently, you have to wait. Then he can involve in the business. Venture capitalists can involve in the business. Whereas the loan customer, the lender cannot go and interfere in the business. You have to wait the business to be carried out, and his position is return has to be, interest has to be recovered. That's all. And it helped the business to establish, but the benefit venture capital is getting the selling of its shares and get the money income. Now this is a very important part. The venture capital normally, that's on the deviation from the normal financial principles. Normal financial principles. So when you look at Islamic financing, Islamic economic system, right, there's no loans, no. So whoever wants a business needs any money, it will be given as a venture capital, equity participation. You generate profit and give part of the profit to be given to the venture capitalist as a part of profit. So return is the loan, return is the percentage is predetermined. Right? Return is predetermined in loans at the rate of 18% per annum. So 18% per annum is predetermined. But in the venture capital, This is profit sharing. No interest, profit sharing. So when they earn profit, go to the capital investment, the capital share is coming to the venture capitalist. So it is profit sharing. That's a principle of Islamic financing. So the venture capitalist is deriving out of this concept, Islamic economic system. Right. So let us see what are the advantages of the venture capital finance, venture capital system. There are first we see economy. What benefit to the economy? Helps the industrialization of the country. Normally high-tech industries, when high risk is involved, banks may not take that risk to invest their money in that business. So the venture capital help the country to go for the industrialization. New industries can be established. Helps the technological development of the country. With the new industrialization, new technology, introducing new technology to the industries is going to develop. It will generate employment, of course. Venture capital, how it is employed? So establishing industries, it will generate employment. Right? Now this concept, can you remember sometime back it was there? When this, if I get back, in 2015, when the Ranil Wickremesinghe Yahapala government came into power, what was his manifesto? What was his manifesto says, Ranil Wickremesinghe's? What is the development plan for Sri Lanka? What is given by him? It is creating 1 million jobs. Rakia Dasalaksha create current law. Create 1 million jobs. What we have to do? The industrial projects should be undertaken and established. So the industries has to be developed. That's what the policy of that government, Yapana government. Now you can go back and evaluate and see to what extent they were success. The very pathetic situation is we don't have any records of what they had done. Why is that? It is not government oriented. Right? People expected government to start these industrial factories and established by the government. No. Ranil Wickremesinghe government at that 2015, he given the opportunity to the private sector to come and start the businesses. Likewise, to expand the country's industrialization. So it will generate employment. Yesterday I have seen that the tire factory in Horana, that government had been started, the Horana tire factory. Now they are going to start the manufacturing, going to start closely, recently. So it has been reached employment, generate employment for that in that industry. So the other one is helps develop entrepreneurial skills. When you start new small SMEs, especially SMEs will develop entrepreneurs. It will develop entrepreneurial skills among the project who are taking the project, and their entrepreneurial skills will be developed. What is entrepreneurial skill? What's the difference between entrepreneurship and a business? What do you call businessman? व्यवसाय क्या व्यापार क्या व्यवसाय क्या व्यापार क्या difference between entrepreneur and a businessman. Businessman does not take risk. He buys and sells. But entrepreneur is the person who convert risk into business. He take the risk, convert into business, and earn profit. That's called entrepreneurship. So what is needed for a country to develop the entrepreneurial skills? When the country develop entrepreneurial skills, definitely the country will be, per capita income will be increased. So it will be helpful for the economy. So the venture capital give that opportunity. Secondly, investor oriented. What is benefit to the investor? More often, the benefit to the investor is that they are invited to invest only after companies start earning profit. So the risk is less and healthy growth of the capital market is interested. Unless the capital investment goes for a seed investment or take-off stage, the third stage, most of the time, most of the opportunities are coming in the third stage. We will discuss the third stages now. And the third stage, that is the company started business and making profit. So at that time, they call invest in investors, invest in their company. So it will investor have lesser risk and healthy growth. Capital market is interested. Capital market will be growing. Profit to the venture capital companies. So venture capital companies are getting profit. Help them to employ their idle fund into productive revenues. So those institutions having funds, idling funds, can be invested for productive, profit-generating projects. Okay. Then third one is entrepreneurial. Third, firstly, for the entire country, what are the benefits to the venture capitalist? Thirdly, entrepreneurial, the person who is doing the business, what are the benefits he is getting? First one is finance. The venture capitalist injects long-term equity finance, which provides a social capital base for the future growth. That is a capital investment, long-term capital investment. So, which is needed for any business, long-term capital investment. It will give the foundation for the sustainability of that business. And the venture capitalist, a business partner, sharing the risk and rewards. Venture capitalist who are investing in venture is a business partner because he is investing in the equity, sharing the risk and rewards. If his business is successful, he gets the risk. Business fail, he had to face for the risk. Then mentoring. Mentoring means giving ideas and promoting the entrepreneurs. Mentoring part. Then alliances. The venture capitalists also have a new network of contacts of many areas that can be value to the company. Make a කතා in Indona. Okay, venture have also a network of contacts in many areas that can be added value to the company. So this venture capital investors having their connections, so they can use their connections to improve the business, to help this venture capital, the project finance. And when the other one is facilitation to exit. Once it is established business, venture capitalists can do exit, sell their shares and exit from the business. That option is available. Okay, the venture capitalists experience the process of preparing company for an initial public offering IPO and facilitating trade sales. Normal venture capitalists, in a business is improved and increasing, so that business can be converted into a limited liability company and sell their shares in a public offering IPO and gain a capital gain. So 3 types of benefits. So it is when discuss the process of venture capital, we discuss first the deal origination. That is what type of a deal, what type of a venture capital is going to be discussed, right? What type of a deal, that is what type of a business, what type of venture it is that. It's called origination. What type of a manufacturing process is going to start. Then the screening. That is screen it for viability of the project. Venture capital before invest, looking into the viability of project. What is the future? Then do evaluation, due diligence. Before investing, all this has to be done. Then deal structuring, what type of facility is needed, how to deal, at what level you are giving at the deal, seed level, nursery level, or second stage or third stage. Then after invested money in the business, involved in the business, post-investment activities, involved in the business, in the management. Finally, exit plan. That means sell the shares and exit from the venture. So this is called complete set of process of the venture capital financing. Right, let's go to types of investors, venture capital investors type of investment. There are 3 types of investors we can see in the market. 3 types of investors. First one is called angel investor. The second one, financial venture capitals. Third one is strategic venture capitals. What is angel investor? Typically a wealthy individual, often with a technology industry background, a position of a judge high-risk investment. There are individuals, those who have money, they are finding places to invest their money, businesses to invest their money. They don't want to deposit the money in the bank and get gilted security and get a small return. They want a high return. They can wait for a long time. So those are called individuals. Often in the high tech industry background, normally those are people who have been, this is India, of course, we have a lot of people who have a technological background. Those are fine, wealthy people. Then high risk investment can be, they can evaluate, judge high risk investment. Usually small investment, $1 million, a very early stage company, to 2 to 3, with a starting of 2 to 3 employees. Starting small ventures. Right? I'll come to Sri Lanka situation and you can very easily understand how best we can invest, go into this area. Small investment, small investment. So this area we call SMEs, small and medium entrepreneurs. The SMEs wanted funds to start their businesses. They don't want loans. They want equity. They don't want loans. Right? They need equity capital. But banks, what they do? They give loans. So that venture, the project cannot be successfully carried out because cost of finance is very high. Most of the projects are failing because the investment plan is not supported by the banks. They need funds, of course, yes. They need equity capital. But that capital has to become way of a capital, not as a loan. So the development of economy will understand this. Then the motivation, dramatic return on investment by exit or liquidity event. Right? The angel investors always look for when the business is established, expanded, then go for a public offering IPO and sell off their shares with a high profit. Exit. Subsequent financing rounds in the particular venture or the project need a finance, of course, again and again it can be given as investment, not as a loan. Right? Interest in technology and industry, mostly industry and technology. Those are the high risk areas. High risk areas to be established. Then comes the financial venture capital. These are the most common type of venture capital. An investment firm, capital raised from the institution and individuals. Now, certain companies, there's a company, venture capital company, is an investment company. They raise their capital from different people, collect the capital funds from the institutions and individuals, people. Sorry? Often organized as financial venture capital funds with a limited loan size, lifetime and exits. Okay? They are organized as formal venture capital funds. Sometimes organized as a holding company. Fund compensation carried interest. And also holding company compensation is IPO, initial public offering. Normal fund sizes are 25 million, 10 of billions, that depend. Now, what is this financial VCs? Financial VCs is a company, it's a finance company, who collects funds from the different organizations and invest in venture capitals. Right? In collecting funds to a company and invest those funds in venture capitals, being a holding company. So it will be the center and given different companies, different ventures company. The fund compensation is carried as interest. So the what you call investment company will pay interest to the investors. And his holding company will get the compensation from selling of shares in IPO with the initial public offering. We are getting higher price for their shares. It's called financial venture capital. That means organization get together dealing in collecting funds and making investments. Right? Now, there are what type of company? Now, for example, where the funds, idling funds are, most of the idling funds are available where? In our country, in Sri Lanka. A lot of idling funds are there where? Yeah. Employee Provident Fund, Employees Trust Fund, Distillers Corporation, gas companies, they have idle funds. So in Sri Lanka, we don't have organized this VC, financial VCs are not there. To invest there, these idling funds in a profit earning. So there should be certain companies come forward to do this. Then we can utilize those idling funds as equity capital for the businesses as a holding company. Okay. Motivation is purely financial, maximum return on investment, IPO mergers and acquisition later on, return getting the company can be merged with other company or take over another company, acquisition and get return. That's the motivation, purely financial intercapital. So maximize return on investment by IPOs, mergers and acquisition. Then comes the strategic venture capitals. Typically a small division of a large technology company. Typically a small division of a large technology company. Example, Intel, Cisco, Siemens, AT&T. These all are Indian companies, right? Examples are all Indian companies. Then corporate funding for strategic investment. Corporate funding, large amount of funds are invested in strategic investments. And also help companies whose success may spur revenue with growth with the VC corporation. Right? That means companies' success may revenue growth on VC corporation. Revenue will increase with the corporation of a venture capital. Not exclusively or primarily concerned with return on investment. The venture capitalists normally, wherever go, they are not exclusive, primarily or concerned with the return on investment. No. Return on investment or the return, the interest is not the basis for investment. And may provide investees with a valuable connection and partnerships. So they will be funds are invested in the companies like in large companies, and it will generate profits, and that profit will be shared by venture capital strategic companies. So it is valuable connection partners can be developed. Typically take backseat role in the funding. So they are not involved in managing the business, strategic basis. Okay. Right. Now let's turn into Sri Lanka situation. Whether we have in Sri Lanka, whether we have venture capitals, whether this concept is applied in Sri Lanka for venture capital. Can venture capital fill the SME finance gap in Sri Lanka? Now, SME is the drive force of urban economy. In Sri Lanka, if you look at past number of annual budgets of the governments, whether it can be Yahapalane or Mahinda Chintane, whatever it is. If you look at the structure of the what do you call this budget, government budget, where they are focusing on development of the country. They are focusing on SME sector, industrial development, small and medium, because 75% of the entrepreneurs in Sri Lanka are SMEs, according to the structure statistics. Therefore, it is the backbone of a country like Sri Lanka, SME sector. But very unfortunately, SME sector financing is still are not taken into consideration. So government is giving more and more energy to the banks to go for this with a low cost fund to start businesses, to reduce their finance cost and generate profits and convert entrepreneurs and profit and generating businesses, which will in turn increase the GDP of the country. That's the idea of long-term idea of the governments. Right? Let's see what are initiatives taken by this government in the past. Most development experts agree that the small and medium-sized enterprises, SMEs, can be effective at reducing inequity and promoting economic growth. Inequality and promoting economic growth. ආර්ථික වර්ධනය සහ අසමානතාවය ආර්ථිකයේ තියෙන අසමතුලිතතාවය අඩු කරගන්න පුළුවන්. The countries balance කරගන්න. ඇති gap එක අඩු කරගන්න. One of the best route is the SME finance, SME enterprises. Yet, SMEs need equity to grow their business. This is the most crucial point. SMEs need equity to grow their businesses. Internal cash flows are often insufficient, and without adequate equity, banks turn their noses. This is the vision. Bank කොවිලක් බලන්නේ P&L එක දිහා බලලා balance sheet එක දිහා බලලා P&L ඉදලා බලලා adequate profit තියනවද? Otherwise banks are not going to. Internal cash flow is a problem. वो startup business එක profit එකක් නැහැ. It will take time to generate profits. So we had wait and see and wait for a long time. So internal cash flows are often insufficient in short term. And without adequate equity, so they are not really high, they need more equity to cover up that position. High equity is needed, but banks are not going to fund. There is less certainty among developer experts, however, on the best way to help achieve that equity. How best we can provide equity for small industries. Banks, the governments have tried different schemes, different schemes with the banks to lend to this sector. And to remember last governments, the Japana government's Enterprise Sri Lanka. What was that? This is one of the projects bought by the government to finance this SME sector. But the government is changed. Now, whatever investment has been, some banks are facing difficulties because the political changes. Now, the same thing is coming as a different label. Old wine in different bottle. Saubhagya Dakma. Still the governments are trying to do the same thing. So what is Saubhagya Dakma? To increase exports, therefore export-oriented products ventures has to be developed, reduce imports, import subsidies has to be developed, and alternative sources. So to do this, finance is needed. Export-oriented products, subsidy of imports, substitutes for the economic growth. So these two are even last government, even this government, all are same, focusing on that. But unfortunately, the path is different. Path is through the bank loans. Bank loans, you can't do that. Even last government given grace periods, then what do you call external funds are received and given as refinance loans, but those are not helping the entrepreneurs to develop because the interest has to be paid. Till the business, before business is matured, the banks need a return. So that is where the mismatch or the making the gap. So the alternative is the venture capital, right? So Asian Development Bank looked into this issue in Sri Lanka and released a report. This in 2016, this report came. Asian Development Bank looked into the issues in Sri Lanka about this capital investment part. On its findings, although the country has few private equity firms, they have enjoyed some recent momentum and have provided equity to successful small businesses that want to be expanded. In Sri Lanka, there are a few companies already established. These private equity firms, companies. Sri Lanka has angel investors that make small investment in startups that often have little more than a simple business plan. In Sri Lanka, we have a lot of angel investors. Who are these angel investors? Moneyed people. Thinking what to do with the money. Where to invest. So they have to find a path for them to invest their funds and generate profits. In middle pace, between private equity firms and angel investors, it's a tradition occupied by venture capital firms. So the gap is to be filled with the venture capital companies or VCs. VCs specialize in investing in firms with proven business ideas but need more equity to expand sales growth. In Sri Lanka, this middle pace is a problem. There's no middle pace. There are businesses there started, they want to expand the business to earn profits. But there are people are there with the funds. So this two has to be matched equally. That is very difficult. The other problem in Sri Lanka, what ADB has looked into, VCs wouldn't have much difficulty finding promising Sri Lankan firms led by smart, hardworking entrepreneurs. But their problem would be arise after 4-6 years later when the VC need to resell its investment in order to return money to investors. The exit risk is there. With essential exit risk. After businesses, venture capital company invest in these businesses, and when the businesses grow, so then the venture capital want to sell their part share. That's called exit. So that exit part is the difficult in Sri Lanka. There's a second problem. SME may not want the money. SMEs may not need the money. Or more accurately, SME may want the money but are unwilling to relinquish the control of that VCs would typically expect. ඇඟිලි ගහන්න දෙන්න බෑ එච්චරයි. සල්ලි දෙන්න බිස්නස් එකට ඇඟිලි ගහන්න දෙන්න බෑ. ඒක තමයි අපේ තියෙන ප්‍රොබ්ලම් එක. So venture capitalists ඒක කරන්න බෑ. When venture capital investment comes, they are involved in the management. Most of the SMEs who want the money not willing to go for the control of these VCs. So VCs looking after their funds. They have to reduce the risk. Only just sell and that's not the idea. So therefore, there's a problem we are seeing in Sri Lanka. These are the findings of ADB. The risk suggests that any Sri Lankan intervention should be first be piloted. Right? So what are the projects they are proposing? Within 3 years, we will know SMEs have appetite for equity in these forms and if the returns are real. If the SMEs are doing well, small and entrepreneurs are starting their business and growing up, doing well, yes, well, there's an appetite for equity, the need for equity, these companies. Then there will be a return for real. Now, problem is if the SMEs are given a loan, they're willing to pay interest. But when SMEs are given venture capital, they are reluctant to give the profit. That's the problem in Sri Lanka. Right? As a pilot, of course, raises the administrative costs, which are now being spread over a smaller base, create further drag on returns. So the cost of maintenance, administrative cost, that is a small base and create a further drag on returns. Yet this makes the case of government support even stronger, for its interest will not be in capturing every rupee of upside, but rather developing a new conduit for VCs to reach promising VCs. So the government intervention is very important to develop the venture capitals. So this is position in Sri Lanka. So what are the ADB venture capital finance SMEs with the ADB funds? How the ADB has come forward to support this governments to support this established venture capital companies. The ADB, Asian Development Bank, is to help Sri Lanka to set up venture capital fund for small and medium-sized enterprises to face difficulties in getting access to finance. The SMEs, which is finding difficult to go to the banks and getting finance, to support them, to develop their ventures, they develop their projects viable to put their products to the market. So ADB has given some funds to establish a venture capital fund. The support comes in response to the government request to ADB to formulate a plan for a venture capital fund for SMEs. And it is aligned with the lending agency's interim country partnership strategy. So normally ADB funds are coming. It has to be rolled out through the banks. It has to either finance companies. So this mechanism has to be developed. Sri Lanka lack of vibrant capital market to support investment and economic growth with the financial market dominated by banks. This is a pathetic situation. In 1979, J.R. Jayawardena government came to power with the 5/6 of the majority from the parliament, changed the constitution of the country more towards what you call market economy principles have been brought. According to the strategic plan of J.R. Jayawardena was to convert Sri Lanka into Asian hub of financial market. Asian hub of financial market. To support this dream or support this idea, 10 foreign banks came to Sri Lanka in 1980s. Bank of America, Indus Bank, BCCI, then number of other some banks, I can't remember the names also. The 10 banks came to Sri Lanka. They wanted to take over this financial market, the capital market of Sri Lanka. So if we have succeeded, we are the next to Singapore and Hong Kong. Strong capital market. But unfortunately, in 1983 riots, everything went off. All the banks went back to their countries. Entire country reversed back. So we are still struggling. This is the position. So here we had to develop vibrant capital market. That means capital products to be put in the market, capital instrument put in the market to sell and buy. That has to be developed. So Asian Development Bank has given a support to that earlier. ADB has said it will also assess the feasibility of SME credit guarantee facility. Right. So this to introduce this venture capital system, ADB has given funds to the central bank to roll out through the financial institutions as SMEs. So whatever venture capital funds given to SMEs through the banks will be guaranteed under credit guarantee scheme by the ADB, Asian Development Bank. So SME credit guarantee scheme එක තියෙනවා. Equity capital is still a constraint on SMEs. Still SMEs or equity capital is a constraint. The venture capital industry is in a same age with only 0.1% of total assets in the finance system of Sri Lanka in 2014. Some venture capital industry The bank said it was partly due to lack of risk management expertise and insufficient funding from long-term strategic investment for the growth. Because Colombo Tribunal, June 9, 2016, published. So this is the position. Right. So Asian Development Bank had made a fund given to Sri Lanka to establish venture capital fund to give guarantees from that to the financial institutions or the venture capital companies coming forward to assist the SMEs. Right, what are these? Let's see. A digital innovation fund aimed to deploy co-ops of rupees 2.3 billion into high potential Sri Lankan startups and will invest most of the fund to early stage companies which each investment ranging between Sri Lanka rupees 50 million to 200 million per company. This fund also set aside 20% of its total amount to invest in startups in their seed stage, especially those which are looking for investment below 40 million per company. Now, this is what the rolling out in Sri Lanka about venture capital fund. A digital innovation fund I already established. 2.3 billion have been allocated in this fund for startups, new ventures, new entrepreneurs to come up to start their businesses and invest most of the fund in early stage companies and which investment range from 50 to 200 million company. Now this is very, very opening. Now let's see how best as bankers we can roll out this. In 2016 it has come to Sri Lanka. Now only 4 years lapse, 5 years going to be. Based on this only, the former government started this enterprise Sri Lanka. Former government started enterprise Sri Lanka, giving this guarantee for the SMEs under this fund through the banks, equity fund. So it is the what you call forerunner of the country's economy. Right? So fund will set up 20% for the startups, starting business, seed stage, starting business. 2.3 billion, 20% companies below 40 million per company. Ranging. Okay, now very important two factors then without politics, just take into consideration. Politics පැත්තකට දාන්න. කොයි ආණ්ඩුවාවත් අපි බලන්න country එක. As bankers බලන්න ඕනේ අපිට තියෙන opportunities, business opportunities. Last comment එකේදී we know that we were deprived of in 2009 we were deprived of GST plus. 2009 දී ලංකාවට තිබිච්ච GST plus එක European Union එක අයින් කරා. They removed the European Union what are given GSP plus. Right? In 2016, the government, Japan government managed to get that part of the GSP plus. Under that, the fisheries ban was removed. Exporting fisheries product to European Union has been removed. Then, European Union has opened 122 items to be exported to European Union without duty. So, if you go to the list, most of these things can be manufactured in Sri Lanka under SMEs. They can develop currently. As bankers, we have to go out and find out who are the eligible entrepreneurs who have been skilled, knowledge. Better කරන්න පුළුවන් කරන්න ශක්තියක් නැතු වෙන financial backing එක. ඒකට තමයි මේ fund එක අවශ්‍ය වෙන්නේ. This is not loan. ඒක මතක තියාගන්න. We are not granting any loan. Under this scheme, we had to work out for a viability project. Project එක viable එක කියලා බලන්න ඕන. Develop කරන්න ඕන. Within 3 years or 4 years, whether it can generate profit. Until such time, we had to wait and see. No return. No return. Now, අපි පොඩි උදාහරණයක් ගමු. ගිය සතියේ ලබන මාසෙම හිතන්නේ ආසියාවේ ලොකුම ටයර් ෆැක්ටරි එක ලංකාවේ හොරන ස්ටාර්ට් කරනවා. It was in the news yesterday. හොරන පටන් ගන්නවා. ඒක කවුද පටන් ගත්තේ? ක්‍රෙඩිට් එක අනුර කාටද කියන එක ඒක අපිට වැඩක් නැහැ. දැන් මේ ඊළඟට ලංකාවේ තමයි ලෝකේ හොඳම කියන්නේ මේ ගල් ටයර් එක නිෂ්පාදනය කරන්නේ. hard tire. So the highest market share of the industrial tires, aircraft වලට ඒ වගේම මේ machineries වලට අවශ්‍ය වෙන ලොකු tires නිෂ්පාදනය කරන the highest market share is for Sri Lanka. Global tires තමයි නිෂ්පාදනය කරන්නේ, export කරන්නේ. GRT, Global Rubber Industries, GRI. Now, earlier we manufacture rubber and just we export raw. Now we are trying to convert a manufactured product. Now we need, now most of our rubber estates has been outdated or expired. Ever than yal panel outdated. So we have to replant and we have to expand our cultivation. Rubber cultivation. So last government has taken up this special to invest in 2 areas to start to give rubber plants. One is in Mullaitivu, that area, Kilinochi Mullaitivu area. Other one is Veeragatiya. Rubber plantation established. The rubber authority are giving plants and giving the funds. Now, if you are given loan to this industry, the new rubber plantations, for example, I give you an example. How long it will take to reach return for us? Rubber plantation එක කරලා ඒකේ ප්‍රතිඵල ගන්න අවුරුදු 5ක් 7ක් යනවා. 7 years. Rubber kapanna pula අවුරුදු 7කට පස්සේ. Till 7 years, we don't have any income. ඒ investment එකේ කිසි income එකක් නැහැ. ඒවනම් ඒ වගේ projects වලට තමයි මෙන්න මේ venture capital අවශ්‍ය වෙන්නේ. අවුරුදු 7ක් බලන් ඉන්න ඕන return එක ගන්න. Banks වල බලන් ඉන්න බෑනේ. So they are not going to invest in that. This is the problem we are having in our economy. So we have to establish new companies doing this. Panga තිබුණ article එකක් එක oh yes, there. Okay. So this is the need of the country. So our venture capital is one of the products, best product for this type of investment. In addition, financing the fund will be provide support to startups and businesses through mentoring, knowledge sharing, and business development. Now, this part is very important. Giving the sharing the knowledge, business knowledge, getting the other country how they do, sharing that. Okay. Potential investees will also gain insight to marketing and other critical business process, leveraging strengths of smart XRTR Digital Innovation Fund. A similar venture capital fund was set up to support incubation programs in Cambodia. Now, how this pay? Smart XRTR Digital? Yeah? Who is this company? Dialogue. මේ dialogue Cambodia වල start කරලා තියෙන මේ project එක. Manufacture මේ accessories. මේ dialogue your innovative digital innovation fund එකක් කරලා similar to venture capital fund set up support incubation program in Cambodia. This will further help create a realized value remains untapped. ලංකාවෙත් මේක පටන් ගත්තා. 2016 වල dialogue එක school leavers කල්ටිය කරගෙන මේ fund එකක් ඇති කරලා දැන් කරනවා. The fund will be managed by BV Capital Fund Management firm that extensive experience investing building and technology focused company. Building technology focus. ඒ කියන්නේ dialogue එකේ technology side එකේ manufacturing. ඒ කියන්නේ chips හදන්න dialogue mobile phones වල interior හදන්න we have our boys are very capable of doing those things. There's nobody to support them. So dialogue has come forward to do that. Right? The founders of BOV company have venture capital instrumental development Sri Lanka entrepreneurial ecosystem over past 7 years. The Dialogue Satya Digital Innovation Fund is one of the many avenues created by Dialogue Satya to enable aspiring entrepreneurs and promising business to grow. So Dialogue have already started in Sri Lanka, this venture capital fund. Other initiatives included Idea Mart and the Idea Biz platforms, which supports over 8,000 entrepreneurs. And I say, you do a service creation environment where services can be constructed across 3 domains, namely telecommunication, internet, and connected devices. So Dialogue has invested in this, developing how entrepreneurs do venture capital financing. Dialogue partnership with incubator, hubs, and awareness program will be collectively contribute towards the holistic vision of excellent digital startups and innovation opportunities in Sri Lanka tech enterprise and entrepreneurs. So if they success, hope we will get success because there's a background is from the Dialogue. They will in Sri Lanka we can manufacture our own mobile phones. Our entrepreneurs will do that definitely. Okay, so finally, what is venture capital? Summarize what is venture capital? What venture capital does? Important thing. Venture capital is a project financed by the way of equity. Project will be financed by equity, capital. Therefore, basic feature is capital investment. It's not a loan. That's not a credit facility. So venture capital is not a credit facility. It's a equity investment. Therefore, no return as interest in venture capital. Venture capital return is the profit. So it's the principle of share in the profit. Venture capital, the benefits are coming out of the profits. Therefore, the profits, to generate profit, it takes time. To generate profit, it takes time. Until such a period, in the lending institutions cannot give grace period. Therefore, venture capital is always waiting till the business is established and start generating profit. After that only, reaping the profit. Profits are coming in thereafter. Two ways of benefits for the venture capitalists. Who are in venture capitalists mean who are investing in the venture capital. Two ways. One is profit generated from the business. Sharing the profit. So there's no fixed income or fixed return. It is depending on the amount of profit will be shared. So I first start with that. This is the concept of Islamic finance. Sharing the profit, no interest. In Islamic financing, no loans. Loans then if you earn some funds to do something, the bank will give that funds to the particular vendor and you collect the item from them. You sell and pay back. So for example, a businessman wants some money to purchase goods. So the bank will give the money to the trader. He will give goods to the borrower. He will sell and pay back the loan. That is Islamic finance. No funds are moving. Money is not a what do you call in the economics, with Western economics, money, cash also are a product. Islamic financing, money is not a product. So venture capital based on that principles. So in Sri Lanka, I think we need the bankers has to open up their mind. Young bankers like you all, a lot of things to do. To do innovative products in your own banks and go forward, look forward for capital gains. Venture capital give the capital gains, but the return is the capital gain. Okay, so we'll discuss two products today. That is venture capital and other one? Yes.
Syndicate.
Okay.
Syndicate loan.
That's very good. Yes. So two products we discussed. These are alternative lending products we have than the traditional products. So next week also we'll try to discuss two more products, which is not very common to us, but still for all needed in this advanced lending products. Okay, right. Any questions? Yeah. Okay, then we'll close down for the day. So we'll meet you next week. We'll discuss the two products, that is factoring and forfeiting, and commercial papers. Two things we'll discuss next week. Okay, right. Good night.